learn how to bank like a bank. Not just how to bank like a bank, but how to transform our debt into wealth. This is critical information that you absolutely need to know, not only to survive, but to thrive in today's financial markets. You guys, I mentioned if you didn't have a pen and a paper that you want to go and grab one, because reality is out of every 1,000 people out there, 990 of them are winging it. They are just guessing at how to do their finances because only 1% of the population are financially literate. So the information that I am going to share with you tonight, you could have a 6-year degree in business and finance and never hear what you are going to hear tonight. So we are going to go ahead and get started. I'm going to begin by telling you just a little bit about who we are and our history. Then we are going to dive into 9 different banking products and principles that are incorporated into our program. So our story began back in 1997 when 2 best friends fulfilled a childhood dream of going into business together. John Wishenko and Skylar Whitman, they founded one of Utah's fastest growing mortgage companies. And it was here that they realized that Americans have a serious problem with debt. They would see their clients come back again and again, year after year, refinancing their homes, but not for the right reasons. Not because they were leveraging that equity into additional real estate or investments, but because they were living beyond their means. They were buying boats on credit, cars on credit, taking vacations on credit. And when the payments got uncomfortable, no problem. They just come back, refinance, and start that vicious cycle all over again. Now, you and I all know that you can only play the musical refinance game so long before you bottom out, before you run out of equity, before you throw off your debt to income ratio, before you mess up your FICO score. And those were just conversations nobody wanted to have. So John and Skylar literally started looking all over the world to find a cure to this disease, which we call debt. And they found something very interesting being used in both the UK and Australia. It was called the One Account. And the One Account was helping people rapidly eliminate their debt and save tons of interest. Now, we have different banking systems here in the States than they do over there. So John and Skylar, they had to retool the program and make it work within our banking structure. But then they did something revolutionary. They did something incredible. They added technology. And in 2004, we launched the first version of what we now call the Money Max account. We did a beta test on 400 homeowners, and much to our surprise and delight, at the end of that beta, not only were our clients on track, but the average client was 20% farther ahead than the program even anticipated. So we went ahead, we launched nationwide, and to date, we've helped our clients pay down over $2.7 billion. That's what they'd be, $2.7 billion in principal. And for every dollar we pay down in principal, we cancel, we eliminate, we wipe off the face of this earth a corresponding $3 to $6 in interest that never has to be paid back. Now, this program was so well received that a high-ranking bank official over at Wells Fargo nominated John and Skylar for the Entrepreneur of the Year award in 2008. Now, Ernst & Young are the largest accounting firm in the United States, if not in the entire world, and they do not easily just hand out awards. They believe in doing intense due diligence. They spent 6 months not only combing through the company's financials, but digging through John and Skylar's personal financials as well. They checked out our longevity, our retention rate, our product viability, and the overall impact that we had on our consumers. And at the end of that deep dive, they presented their findings to the board, and John and Skylar received the Entrepreneur of the Year award in financial services in 2008. That should speak volumes. What was going on in the financial world in 2008? The sky was falling, and they literally saw this as the solution to that problem. Since then, we've been featured in almost every single industry related magazine out there. And other companies who've received this award, Starbucks, eBay, Microsoft, Apple. So we stand, among giants. And friends, since then, we've gotten an A+ rating through the Better Business Bureau and a 4.9 star rating on Trustpilot. So solid company. Now that you know who we are, let's start talking about these 9 banking products and principles that come together to create the most effective and aggressive debt to wealth program on the market today. We're going to talk about closed-ended loans and mortgage amortization, interest cancellation, open-ended loans and lines of credit, offset accounts, float and leverage, interest accumulation, strategic debt payoff, and my favorite, arbitrage, because that word arbitrage is the magic behind turning your debt into wealth. And it literally allows you to use the same dollar twice. So what do we know about closed-ended loans? Well, first of all, we know that money only goes one way. You can make payments in, but you cannot take withdrawals out. It requires at minimum a full scheduled payment. It is driven by an amortization schedule, which means money applied today does not affect your interest charges until next month because it calculates interest charges off of the previous month-end balance. So what did I just describe there? Yeah, that's our mortgage. That's our cars, our boats, our ATVs, anything that has a start date and an end date, that is a closed-ended loan. And the primary takeaways are they're very restrictive, literally zero flexibility. And if you stick with your lender's plan, you are flat out going to pay way too much money in interest. That takes us to our next banking principle, mortgage amortization. And throughout our conversation tonight, we are going to be referring to a $400,000 loan with a 6% interest rate amortized over 30 years. The payment on said loan is $2,398.20. And if we look at the breakdown of that payment in month number 1, we see $398.20 going towards principal and $2,000 going where? Yeah, towards interest. And friends, that's not 6% on any planet. That is actually 83% of the payment going towards interest in month number 1. Now, the good news is that every single time you make a payment, a little bit more is going to be applied towards principal, meaning a little bit less goes towards interest. So if we look at month number 2, I wasn't kidding when I said it was just a little bit. It's less than a $2 difference. Is it any wonder that it takes this type of loan 30 years to pay off? So let's look at the end of year number 1. We have now paid over $28,000 on this loan, but our equity position is less than $5,000. Year number 5, we've now paid over $143,000 on this loan, $27,780. It was our principal reduction, meaning that $116,000 went where? To interest. Friends, what did that interest buy us? Did we get a couple extra bedrooms? Maybe a few extra acres out back? No, we got absolutely nothing, because another word for interest is bank profit. Friends, that $116,000 did no more good for you and your family than had you taken it outside, lit it on fire, and watched it burn. The crazy thing is, this is where the average American has been conditioned to refinance and start this vicious cycle all over again. If you think that's an exaggeration, when you go to work tomorrow, ask your colleagues, ask your friends, hey, how many years do you have left to go on your mortgage? You're going to hear 27, 29, 28, 30. I just refinanced. Very seldom do you come across somebody with less than 25 years to go. But we're going to continue with this example. Year 10, we've now paid over $287,000, and the bank has given us credit for a little over 65 grand. Year 21, this is a special year in this mortgage. We have now paid over $604,000 on a $400,000 loan. But the good news is we've reached the halfway point. Yes, we now owe just under $200,000, and we have just over $200,000 in equity. How 21 years is half of 30, I will never know. But friends, that's just the absurdity of bankers' math. And if we were to make every single mortgage payment on time over this 30-year period on this $400,000 loan with a 6% rate, we would actually pay back $863,000. And that's not 6%. That is 116% more than what you borrowed. And you know what I call that? That is legalized theft. It's legal. You signed the documents. It's theft. You didn't understand what you were signing because no one has ever taken the time to educate you on the difference between a 6% annual percentage rate and 116% total interest percentage. You see, the banks, they sell us on APR, but they charge us on tip. Now, some of you might be thinking, whew, I dodged that bullet. I don't have a 6% rate. I refinanced during the pandemic. I have a 2%, a 4%, a 3% rate. Friends, if you take any notes on our conversation tonight, I want you to write this one down. I want you to write it big. I want you to write it bold. I want you to underline it. I want you to give it an exclamation point. I even want you to go to chat right now so I know you're listening and write down rate does not matter. Yes, I just said that. Rate does not matter, at least not as much as you think it does. It's the type of product you are using and how that product is and how the interest is calculated. And I will prove that to you mathematically tonight. And for those of you who stick around to the very end of this meeting, I'm going to give you guys a gift. And it will help you remember everything that I am teaching tonight. So our next banking principle is interest cancellation. And as you recall, with a closed-ended loan, we're required at bare minimum to make a full scheduled payment. So we're going to do that in month number 1. We're going to pay that $2,398.20, $398.20 will go to principal, and yeah, $2,000 is going to go towards interest. But what if on top of our regular scheduled payment, we decide to tack on an additional $2,021.06? What's that going to do to our mortgage? Well, logic would tell us if I've got $2,000 going towards interest and I make an additional $2,021 payment, I should cancel about 1 month off of the back end of my loan. Well, friends, I am happy to tell you logic is wrong because principal and interest, they are connected. And anything you do to the principal, that affects the interest. So the single $2,021.06 principal accelerator, it doesn't cancel 1 month off of the back end of your loan, not even 2, 3, or 4 months. The single $2,021.06 principal accelerator, it cancels 5 months off of the back end of your loan and actually saves close to $10,000 in interest. Now, in any other arena, would you be willing to invest $2,000 to make 10? Yeah, that is a very equitable arrangement. But what if we're not thinking big enough? What if instead of putting an extra $2,021.06 on top of our mortgage, we put an additional $5,000? And what if it doesn't have to be your money? What if it can be your lender's money? What if it could be your insurance company's money? Friends, that is exactly what I'm going to teach you how to do tonight. So our next banking principle is open-ended loans and lines of credit. What is different about an open-ended loan compared to a closed-ended loan? Well, first of all, money goes both ways. Yes, you could make payments in and turn around and take withdrawals out. It also requires only a minimum payment rather than a regularly scheduled payment. It's driven by a draw period, and this next one is my favorite. Money applied today affects today's balance. Literally, you make a payment and the clock stops. They recalculate the principal, they recalculate the interest, and your payment is based on that dollar amount because it calculates interest charges on an average daily balance. You see, friends, banks are smart. They are so incredibly smart, and they understand and take advantage of a concept called no stagnant money. And what that means is money doesn't sit idly around doing nothing. It's always moving. It's earning interest, it's canceling interest. And yes, in some cases, it does both of those things simultaneously. Now, smart investors, they do what the banks do. And the Money Max account, it will help you move the right amount of money at the right time from one account to another, and then let it sit for the right period of time. You know what else banks do that's genius? At the close of business every day, they sweep all of the money out of everybody's checking and savings accounts, and they invest it into high interest bearing accounts for their special clients and themselves. Yes, banks use our money to earn interest for themselves while we sleep. They understand that money's the best employee they are ever going to hire. It works 24/7, 365. Friends, don't you think it's time you get your money working for you? How many of you here tonight would like to have a sweep account of your own? All hands should go up on that. Well, you can have a sweep account. Sweep accounts are known by other names as well. Another name for a sweep account is an offset account. And offset accounts are just a place where you can park your money for a specific period of time where it's going to earn interest, cancel interest, or in some cases, do both things simultaneously. And all offset accounts, by their very nature, are open-ended accounts. Here at United Financial Freedom, we have 3 different offset accounts available. The first one, this was our flagship product. When we launched in 2004, introducing Velocity Banking to this country, this was our one and our only offset account. And it allowed our clients to rapidly eliminate their debt and cancel tens, if not hundreds of thousands of dollars in interest. Then remember 2008 when that financial sky was falling? What did the banks do? They flat out quit issuing home equity lines of credit. So we could have chose to close up shop, but we didn't. We invested another $19 million in research and development. We were able to eliminate our reliance on the home equity line of credit, and now our program works just as well with a checking and a high yield savings account. You're able to rapidly eliminate your debt, cancel tons of interest. Now, what did this mean to the public? This meant our program now works for any debt, for anybody. Because if you don't need to have a HELOC, you don't have to be a homeowner. And if you don't have to qualify for a HELOC, you don't even have to have good credit. So now we work on any type of debt. If there's a principal amount, a balance, and an interest rate, we can crush and destroy it in record time. Then we spent the next 10 years searching for the perfect offset account, an offset account that would allow us to earn interest and cancel interest simultaneously, literally using that same dollar twice. And we landed upon the high cash value permanent insurance policy. Friends, this, in my opinion, is our best offset account because it allows you to do 2 things with the same dollar. So now we are going to start discussing canceling interest using an offset account. So we still have our same $400,000 mortgage that we were talking about earlier. And now we are introducing an offset account. Remember, it can be a HELOC. It can be a high yield savings account. It can be an insurance policy. In this example, we are going to start out with the HELOC. But don't worry, friends, We will get to that high cash value permanent insurance policy before we are done tonight. So here, remember when I said, what if that $5,000 didn't have to be yours? What if it could be your bank's? In this example, it is your bank's. We have a home equity line of credit. It has 10% interest rate and $25,000 available. Now, how many of you here tonight would use 10% money to pay off six? Yes, I did say that right. How many of you guys would use 10% money to pay off six? I know, that is crazy talk. It flies in the face of logic. It is counterintuitive. Any sane person would use 6% money to pay off 10, but never the inverse. Friends, if you're thinking that way, it's because the bank has done a fabulous job of brainwashing us into believing that rate actually matters. What was that one note I encouraged you to take just a little while ago? Oh, yeah, rate doesn't matter. And this is where I'm going to prove it to you mathematically. So that $5,000, we're going to borrow from the home equity line of credit to pay down the first mortgage. Now, at first glance, doesn't look like we've accomplished anything. We still owe the same $400,000. But what we did do was we took $5,000 of a balance that we had zero control over, and we moved it to one where we have 100% control over it. And that single strategic funds transfer, it canceled over $24,000 in future interest and eliminated a full year off of the back end of this loan. Yes, I know that is incredible, but some of you are thinking, yeah, Di, that's great, but you just borrowed $5,000 at 10%. That money wasn't free. Well, you're right. Let's do a little bit of math. So what is the payment on that $5,000 in month number one? That would be $41.67. Anybody here willing to pay $41.67 to save over $24,000 in interest? I mean, that is a very equitable arrangement. Give a girl an amen on a weekday. But what if it takes us more than 1 month to pay back that $5,000? Okay, let's say it takes 6 months. And let's say instead of $41.67, that the cost is $50. Now it's not 50, it's $41.67. But just to keep math simple, we're going to pretend it's 50. 50 times 6, $300. Anyone willing to pay $300 to save over $24,000? I see hands going up on that one. Let's say it takes 12 months, a full year. Well, 12 times 50, that's only $600. Anyone willing to pay $600 to save over $24,000? Now I'm going to be ridiculous and say it takes 5 years to pay back $5,000. Friends, that's still only $3,000. At which point does this scenario stop making sense? That would be at the point where it costs us more in interest than we actually save. And that wouldn't happen in a 30-year period. So now that we all agree that rate doesn't matter, let's move on to our next banking principle. Now, this one, I bet every single person on the call has mastered. You just didn't know it had a name: float and leverage. So what do I mean by that? When your car is out of gas, what do? You swipe the credit card. When you need a cup of coffee, what do? You swipe the credit card. You're out of groceries, we swipe the credit card. It's date night, we swipe the credit card. You get the picture. We use our credit cards every single day, every single week, every single month, all month long. But what do responsible cardholders do at the end of the month? Yeah, we pay those suckers off in full because we understand even if they have a 36% interest rate, if we pay them off every month, how much interest are we charged? Nothing. We literally leverage our lender's money interest-free for 25 to 45 days, depending upon the cardholder. We just float that balance. Again, I've got to ask, what if we're not thinking big enough? We're just adding to our story line upon line, little by little. We still have our $400,000 mortgage at 6%. We have our home equity line of credit that is at 10%, and we are now using it as our primary checking account. Now, this particular client, their net income happens to be $5,000. So when they get paid and they put the money into the HELOC, it pays it down to zero. How much interest were they charged for the use of the bank's money in month number one? Nothing. But what are they supposed to live on? That would be our friendly neighborhood credit card, of course. And yes, I said friendly and credit card in the same breath. Because, friends, when you understand how to use these different financial instruments, they really can be your best friends. So we're going to put everything on that credit card, say to the tune of $4,000. We're going to put the groceries, we're going to put the gas, we're going to put the soccer cleats, we're going to put the insurance, we're going to put the cell phone bill, everything. We're earning rewards points and cash back and Sky Miles, all the benefits of having a credit card. And then at the end of the month, when the payment's due, we write one check from the home equity line of credit and pay that down to zero as well. So how much did the bank charge us for the use of their money on the credit card? Nothing. How much did the bank charge us for the use of their money on the HELOC? Nothing. And we saved over $24,000 in interest. Folks, if that is not fantastic and exciting, I don't know what is. But you know what's even more fantastic and exciting than rapidly paying off your debt and canceling a ton of interest? That would be rapidly paying off your debt, canceling a ton of interest, and building wealth simultaneously at the same time. So in order to learn about that, we've got to switch gears. We're not going to talk about the home equity line of credit anymore. We are now going to talk about life insurance. And friends, there are a lot of different types of life insurances out there, but they fall into two categories. We've got term and we've got permanent. Now, term insurance, it's super inexpensive. It provides coverage for a specific period of time. And, it can be renewed at the end of that term, but oftentimes it is cost prohibitive because it's at a much higher rate and it does not build any cash value. So term is great because you can get a lot of insurance for a little bit of money. Just know it's not going to be there for your entire life. That brings us to our permanent insurance. Now, permanent insurance, it's just that. It's designed to be there for your entire life. Not only is it protection, it also builds a cash value, and you have access to the funds inside of it whenever needed. And when you pass away, the outstanding loan balances, they're just subtracted from the death benefit. Now, we have a lot of different types of permanent policies. We've got whole life, we've got universal life, we've got variable life, we've got indexed universal life, and they all differ in how the premiums are paid and how the cash accumulates. For our Money Max Pro, we're going to focus on the indexed universal life insurance policy, the IUL, that I like to refer to as the Swiss Army knife of finance. This IUL, it has so many incredible features. First of all, you have guaranteed minimum interest rates. You also have access to your money whenever you need it because there's no such thing as that 59.5 rule for the required minimum distributions at 71.5. And you will never, ever, ever lose principal because we have a 0% floor, and zero literally becomes your hero, especially in the volatile market like what we are seeing today. In addition to that, there are living benefits, and these benefits, they kick in upon diagnosis of heart attack, cancer, stroke, the inability to perform 2 out of the 6 activities of daily living. We also have this money is going to grow tax deferred because we're contributing it with after tax dollars, and it's actually tax free. And we're able to take out tax advantaged, again, tax free loans based on tax code 7702A. And this is the kicker. Even after money is withdrawn, it continues to grow. Yeah, that one sounds too good to be true, doesn't it? How can our money continue to grow after we take it out? Well, friends, the banks are masters of this concept, and it's called arbitrage. So let's take a look at arbitrage. If you were to go down to your bank today and apply for a mortgage, they're probably going to charge you right around 7%. You need a business loan, 8%. Credit cards, 24%, 29%. Auto loans, 6%. Personal loans, 12%. Now, this is what the banks charge you for the use of their money. Now, what do they pay you for the use of your money? Like nothing. Checking accounts, you're lucky if you get 0.01%. Credit unions, maybe 0.25%. High yield savings accounts, 3 to 5%. This doesn't really make any difference when inflation is 2 to 4%, or more recently, 6 to 8%. So the bank, let's say they're charging you 24% on a credit card, and we're going to be generous. They're paying you 5% on your savings account. That is 19% positive arbitrage. Or let's say you go to them and you want to buy a house. Do you think they have $500,000 sitting in a vault waiting for you to come and borrow it from them? Of course not. They're going to go to a primary lender, a bigger bank, and they're going to borrow the money from them. Let's say they get it at 5%, they loan it to you at 7%. Now there's that 2% positive arbitrage. So is it too good to be true to be able to earn money and cancel money at the same time? Absolutely not. So let's take a look at how this works with our life insurance. The IUL is built on 3 pillars. There is an account value, there is a cash value, and then there are living and death benefits that collateralize your loan and also protect your plan. Now, the account value, it never goes down. The cash value, it's going to fluctuate based upon your use of the money. So let's say that you go and you borrow money out of your cash value. Well, that money never leaves your account value. It stays fully vested. You actually borrow it from the insurance company's general fund. So if the account value, let's say it's growing at 6%, let's say that you borrow the money from your insurance company at 5.5%. Now we're seeing a 0.5% positive arbitrage. So you have access to your cash when you need it, yet it continues to grow even after it is withdrawn. So you guys, that is arbitrage, and the banks have been doing this for hundreds of years. So now that we understand that, let's start talking about interest rates. The rule of 72. This is an old accounting rule, and it simply states that you can take any interest rate that you're paying someone or they're paying you, divide it into 72, and that's how long it takes your money to double. So if you're earning 3% on your money, you divide that into 72, it will double in 24 years. 6% divided into 72, it doubles every 12 years. 12% divided into 72 doubles every 6 years. So let's say you have $1,000 and you're earning a 3% rate of return. That means in 24 years, you'll have $2,000, and in 48 years, you'll have $4,000. If you're earning 6%, it's doubling every 12 years. So at year 12, you have $2,000, year 24, $4,000, year 36, $8,000, year 48, $16,000. And then you can see how the money doubles every 6 years if you're getting 12%. And the difference on that same $1,000 investment is $256,000. So if you had $1,000 at the end of 48 years, would you rather have $4,000, $16,000, or $256,000? Yeah, me too. So now that we've talked about interest rates, let's talk about where we find such rates. You want to get those, lower fixed guaranteed rates. You can find that in savings accounts, high yield savings accounts, CDs, and saving bonds. Nice and safe. But friends, what's the problem with nice, safe, fixed rates of return? You have to throw in a lot of more money if you want to retire with dignity. So where do we go if we're seeking those double-digit returns? Well, now we need to go to the market. We're looking at things like 401ks, IRAs, and stocks. But what's the problem with these variable type products? Yeah, they're all over the place and there's no guarantee. And because the market goes up and the market goes down, again, if you want to retire with dignity, you need to put in a lot more money. So when it comes to planning for your financial future, which is more important, safety or growth? Yeah, that's a trick question, guys. You actually need both safety and growth. And there happens to be a product out there that gives you both. These are indexed products. They guarantee that you never lose a penny, but they also allow you to participate in the upside of the market. So the next thing we want to talk about is everybody's favorite subject, especially this time of year, taxes. Yeah, here in the United States, we have the ability to choose when and how we pay our taxes. So you could choose to pay your taxes now. Okay, this is non-qualified money. You could pay it or invest with after-tax dollars and pay on the growth every single year, like your CDs, your savings, your mutual funds, and savings bonds. You also have the ability to delay taxes to a later date. So you can fund things with pre-tax dollars, and that's like your 401k, your IRA, and these have penalties if you try to get into them before age 59 and a half. So we could pay our taxes now, we could pay our taxes later, or again, we could have the best of both worlds and fund our investments with after-tax dollars, let them grow tax deferred, and withdraw your contributions tax-free. Where can you do that? Roth IRA, life insurance with cash value, and in many states, that's also available in municipal bonds. So Warren Buffett, we all know this guy. He is the Oracle of Omaha. And he says there are two rules when it comes to making money. Rule number one, never lose your money. Rule number two, don't forget rule number one. Friends, wealthy people, they do not lose money in the market, nor do they pay unnecessary interest on their debts. And they understand and take advantage of the tax code. Those are all things that we teach inside of the Money Max Pro. We focus on 4 principles. First, we decrease risk. Because you have a life insurance policy with living benefits, the risk is taken off of the table. If you die prematurely, your family's still going to get out of debt and live with dignity. If you get sick along the way, you're still going to get out of debt and live with dignity. What is the number one cause of foreclosure and bankruptcy in this country? Major medical. And with living benefits and death benefits, that's off the table. We also help you decrease your debt by helping you implement those 9 different banking products and principles. We decrease your taxes. We help you increase your rate of return. And this one I think is so important. We help you avoid procrastination. You don't have to wait until you're debt free before you start saving. And time is money. And thanks to arbitrage and the ability to use that same dollar twice, you can get out of debt and build wealth simultaneously. So let's take a look at another one of our banking principles. If this was you and these were your debts, in addition to your mortgage, let's say you have 5 other payments going out, so a total of 6. Which one of these would you choose to pay off first? Yeah, that again is a loaded question because the gurus can't even agree on that one. We've got one guy out there saying, oh, attack the lowest balance and build momentum. Somebody else says, no, attack the highest interest rate and pay as little as possible. Somebody else said, it doesn't matter, just pick one. And someone else says, let's put a little extra on all of them. Friends, which is the fastest mathematical way to zero? Is it the snowball? Is it the avalanche? Is it the target? Does it even matter? Well, choosing the wrong debt could actually cost you tens to hundreds of thousands of dollars in unnecessary interest payments. And if you understand factorial math with just 6 different payments, There are 720 different sequences or options to choose from. So which is the fastest mathematical way to zero? What is missing from this situation? I'll tell you, it's too complicated to do manually. No one has the time. No one has the systems to do it themselves. It's too complex to navigate, and there is no strategic debt payoff. Wouldn't it be nice if somebody came up with like a GPS for our finances, something that would tell us when and where to move our money and how long to let it sit? Well, the good news is we have the answer because finance has finally caught up to technology. And we have the first, the one, the only web-based interactive debt to wealth program on the market today. It tells you how much money to move, the exact dollar amount, when to move it, the exact date, from what account to what account, the most strategic accounts. It takes a look at every single financial aspect of your situation. It looks at how much you owe, the terms of each debt, the interest rate, the payments, your income, literally everything. And when unexpected things happen, life, like the car breaks down, the dishwasher leaks, or the dog swallows a rock and needs emergency surgery, those type of things, the program just recalculates and gets you right on track to the fastest mathematical way to zero. Just like your GPS tells you how to get from point A to point B, that's what the Money Max account does. All you need to do is follow the directions, follow the arrows. So let's talk about strategic debt payoff and cash flow. How does this work? Well, we have our checking account, we have our HELOC. When we get paid, money goes into our checking account. The program analyzes every aspect of our financial situation. It knows what our minimum reserve amount is because we set it, and then it prompts a funds transfer over to the line of credit, paying it down. When we get paid again, it does the exact same thing, analyzes every aspect of our financial situation, honors our minimum reserve, prompts a funds transfer until we reach an optimal transfer point, at which time the program will take a look at all of your debts and tell you which debt or debts to apply your additional funds to. How does it work if we're using a high yield savings account or a cash value insurance policy? Exact same way, but backwards. Money gets deposited into the checking account. Program analyzes every aspect of our financial situation, honors our minimum reserve, prompts a funds transfer over to the high yield savings or the permanent insurance policy. When we get paid again, it does the exact same thing, prompts that funds transfer over to the savings account or the insurance policy. But instead of paying down a debt balance like it did with the HELOC, we're building up a cash reserve until we reach an optimal transfer point, at which time the program takes a look at all of our debts and tells us which debt or debts to apply the additional funds to. So with a line of credit, we are paying down a debt balance to the optimal transfer point. With a savings account or an insurance policy, we're building up a cash reserve. Now we're going to have some fun. Let's talk about a sample client. This is John and Rebecca Jones. Now, John and Rebecca Jones, when they were first introduced to the Money Max account, they were using the home equity line of credit method. And they were really excited about it because that was going to take their 30-year mortgage and pay them off in just 7.3 years. But shortly after starting their MMA journey, they found out about our wealth building account, the IUL. And they decided that they wanted to not only get out of debt and save interest, they wanted to build wealth. So we started them by putting $500 a month into their IUL. And that's $6,000 a year, giving them a death benefit of $774,000. Now they put in that $500 a month and they follow the additional funds transfers every time the program identifies additional monies. This means they're going to be out of debt in 8.3 years instead of 7.3, because we're going to spend that first year building up our cash reserve. But friends, this is what makes it worth it. At the end of that 8.3 years, they have over $45,000 in their cash value, and their death benefit grew to $820,000. But the exciting part is right here. They have a $359,000 jump start on their wealth. Yes, friends, instead of just getting out of debt in 7.3 years, they're debt free a year later, but they have an accumulated account value that is earning uninterrupted compounding growth of $359,000, and they have 45,000 cash value still in the policy. This is phase one. And at the end of phase one, once they are debt free, if they never put another penny into this policy again, when they're 65, they could retire with an additional $32,651 in tax advantage. That's the legal word for tax-free retirement income. That gives them an additional $848,000 in retirement income between the ages of 65 and 90. But friends, once they're debt free, if they decide to continue to bank like a bank, and so now they're not just putting their discretionary income into their wealth building account, they're also putting their previous debt payments. Now they're putting in, whoops, I clicked too fast, sorry, a grand total of $4,018 each month. And this money, it's available whenever they need it. When they get ready to retire at age 65, they will have an accumulated account value of $1.5 million. And that is a monthly tax-free retirement income of over $13,000 or $157,000 annual income. If they pass away at age 90, there's still over $600,000 to go to the next generation. Yes, we are talking about generational wealth. We are talking about legacy planning. And this, my friends, is a $4.7 million net tangible benefit for the Jones family. Also, it comes with these living benefits at no additional cost. So friends, this plan is bulletproof. If they die prematurely, the family gets out of debt and they live with dignity. If they get sick along the way, they get out of debt and they live with dignity. If they live a long and a healthy life, like most of us are going to do, we get out of debt and live with dignity. So how does the home equity line of credit method compare to the permanent insurance method? Well, if we look at interest savings, the HELOC beats the permanent insurance policy. Why is that? There is a cost to the insurance, and we spend the first year building up our cash reserve. The HELOC also gets you out of debt a full year sooner than the permanent insurance policy. Again, we spend the first year building up the cash reserve. But this is where the home equity line of credit, the HELOC, and the permanent insurance policy pulls ahead of the HELOC. It has income protection, a fancy word for life insurance. And this program begins with $820,000 worth of protection. This is the big kicker. Wealth accumulation at age 65, once they're debt free after 7.3 years, if they put all of their money into savings, by age 65, they could have $1.2 million. Inside of the permanent insurance policy, it's $1.5 million. It doesn't look like a big difference. It's only $300,000, but it's not how the money goes in. It's how it comes out. Because if this money, the savings, was in a 401k, an IRA, or even just a savings account, as you take the money out, you withdraw it, your account value goes down. Whereas with the permanent insurance policy, as you take those tax-free withdrawals from your policy or loans, the account value never goes down. You continue to earn that uninterrupted compound growth. So the difference in retirement income is, with the HELOC method, $3,893 taxable income compared to over $13,000 tax-free income. Again, that is a net tangible benefit of over $4.7 million. So this is all pretty exciting. And John and Rebecca, they're thrilled. But you know what? In addition to building wealth inside of an IUL, they get this crazy idea that they want to be real estate investors too. So how in the world is this going to work? Well, now we're going to, when they get paid, the money goes into their checking account. The program's going to analyze every aspect of their financial situation, and it's going to prompt the funds transfer over to their life insurance policy. When they get paid again, the program analyzes every aspect of their financial situation, honoring their minimum reserve, prompting the funds transfer over to the high cash value permanent insurance policy. Now, John and Rebecca, they got the down payment for a rental property out of their HELOC. So now the life insurance policy is going to focus on paying down the balance of the HELOC so that they can purchase a new home. And we can just wash, rinse, and repeat the cycle over and over again. Every time we pay down the HELOC, we could purchase a new home. Pay down the HELOC, purchase a new home. So John and Rebecca, at the end of just, we're not clicking there, at the end of just 10.4 years, they don't only own their home free and clear, they also own a fourplex free and clear. And friends, like I said, they could wash, rinse, and repeat this over and over again. Maybe have 2 investment properties, 3 investment properties, 4 investment properties, all following the prompts built into your Money Max Pro account. This program that you just saw, I know it might be a little overwhelming, but the MMA Pro takes all the guesswork out of it. You just follow the arrows, and it is backed by science. This system, it is the first, the one, the only web-based interactive debt-to-wealth program on the market today. It has 4.5 million line items of code, hundreds of mathematical algorithms, advanced banking strategies, and factorial math. And it connects with over 13,000 banks and lenders. It might sound like magic that you just saw. It's nothing but math. So what's your next step? You want to get back with the debt elimination wealth creation specialist who invited you here tonight. Ask them to run a complimentary, yes, a free debt to wealth report so you can see your guaranteed get out of debt date and how much wealth you could potentially build. And with that, friends, I want to thank you for being here tonight and for sticking around until the very end. If you go to our chat, you are going to see that there is a download available in both English and Spanish for you, so that this is a book called Wealth Beyond Debt. It was written by our Chief Strategy Officer. His name is Jason Ingram, and it explains everything that I just shared with you tonight so that you don't have to rely on your memory. You can have a book to do it for you. So friends, again, I'd like to encourage you, get back with whoever invited you here tonight. Have them run your complimentary debt to wealth report. Get your questions answered and become debt-free and financially independent. Thank you all for coming, and I look forward to seeing you again soon. Good night, everybody.